Well, what is going on, guys, and welcome into the video. So because stocks have gotten so juicy, is it time to access the 7 figures of debt instruments that I have at my disposal to pour into stocks? I mean, a lot of people's cash has inevitably started to deplete or is completely depleted from buying the dip, and I'm not completely immune to it either, guys. I mean, it's not like my name is Jerome Powell. I can just print money like crazy. I can't do that. So the question that eventually comes around to all of us for us to think about, and that is taking out debt to buy stocks. And I'm not just talking about margin here, guys. I'm talking about all kinds of different debt instruments to buy stocks. So let's tackle this question today and get you guys the right answer on how to get more money to invest in this crash. I promise you there is a great answer to this question. I just ask in exchange for you to gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. Make sure you got that little bell turned on for notifications too, or else YouTube won't show you my videos even though you're subscribed to my channel, and it's silly. I know, guys, I'm sorry. All right, so let's cover margin debt first because it's the easiest and I think it's the one that you are the most familiar with, and it gets talked about the most here on YouTube. But just kind of so we are all reading from the same sheet of music per se, and there is no kind of confusion, here's the definition per investor.gov. A margin account is a type of brokerage account in which the broker-dealer, essentially Robinhood or Fidelity or whoever you use, they lend out the investors cash. Using the account as collateral to purchase securities, margin increases investors' purchasing power, but also exposes investors to the potential for larger losses. So they basically collateralize your entire account in exchange for the amount of cash to invest in, which is great. I mean, now you have cash to buy. The problem? Well, the brokerage firm charges interest on the margin funds for as long as the loan is outstanding, increasing your cost of buying the stocks that you're trying to buy. You are not just buying the stocks with a set amount of money. Now that money used is having interest kind of accruing against it, cutting into your gains even if the stock is going up. And if the stock actually declines in value, which is pretty much every stock in the stock market right now, you are now losing money and will have to pay interest to the broker on top of that. And if a margins account equity drops below the maintenance margin level, which can change, and sometimes it's not clear to you as the investor as to what the level even is, the brokerage firm can make a margin call to that investor. In this case, that would be you. And if that happens, you normally only have about 3 days or so to deposit more cash or sell some stocks to get back on the right side of that maintenance margin level. But it gets even worse than that. A brokerage also has the right to just sell the investor's securities if the brokerage feels their own funds are at risk. And the definition of at risk is very much at the discretion of the brokerage. And if you think they have your best interests in mind, you better think again, my friend. They really don't. They can liquidate you anytime they feel they are at risk, regardless of what is actually happening with your stocks or your personal situation. It just doesn't matter. And they can also sue you if you do not fulfill the margin call or if you're carrying a negative balance in your account. Bottom line, I never mess with margin. And here's the reason why. Not just for the reasons we just listed, but there's more reasons than that. It is a sophisticated tool for sophisticated traders, and it's intended for short-term moves, not for long-term investors who buy and hold like most of us who watch this channel do. And I don't care what any other YouTuber says that it's a great tool to ride to the moon and get rich faster. That is total garbage and just a misuse of the tool to begin with. You don't YOLO with a Tesla dip using the margin, waiting for it to hit your price target in 5 years. And I don't remember Warren Buffett going,
"Man, I sure could have bought a lot more Apple stock or Coca-Cola stock if I used margin too. Think of all the juicy gains I would have if I used it in addition to my massive cash pile."
And neither has any other great investor who has ever done it has ever said that. Ignore that trash altogether unless you are a sophisticated trader, which means you're not watching a long-term buy and hold investor like me. Wait, what the heck was that? What is going on? What?
The Halloween flash sale is live for the Market Insiders private group, where you get direct access to me anytime, and we have live weekly Q&As, tons of exclusive videos and tutorials, and you see the website that tracks my watch list complete with my price targets, and you get access to 5 courses for free since we just released our real estate course on how to live for free anywhere in the world, and it's been a huge hit with the members so far. The spooky sale does end after Halloween, so make sure you lock in your discount pricing for life as long as you stay a member. So check out the pinned comment below and at least see what is offered.
So clearly that wasn't the answer for us, but what about taking out a nice, conservative, low fixed loan rate to buy stocks with? I mean, if the market returns 8% on average and you are paying 4% on that debt, for example, with a 3-year payoff, you are making 4% minimum, right? Well, there are actually 3 big problems with that line of thinking. And the first is, you are assuming the 8% growth is kind of linear like the debt is, and it's not. You could be down 15%, 20% or more this year, and then next year be up 20%. And if it's a 3-year note and the market has a rough 3 years, or 2 of the 3 years, your average may not be 8%, but a lot lower if the market's down during that time frame. In the meantime, the debt grew by 4% compounding, which perfectly ties to the second point, which is your return is not actually 8%, because in this scenario, remember, you got no cash to buy anything. That means you had to sell some to make the payments, so the investments you made are not compounding 8% a year like the debt is compounding 4% each year. The debt is based on a schedule that takes full advantage of compounding 4% over the entirety of the loan for the entire loan amount. You based your 8% return on compounding as well, except you're only getting 8% on a reduced amount each month because you're doing this because you don't have the cash, so you have to sell to service the debt, and therefore you're not getting the full benefit of compounding, unlike your debt, which is getting that full benefit. And if the market is down that month, you sold low and actually made your yield even lower overall. The indexes do go through years where they don't return well, meaning you are selling in a down market like we're in right now to service the debt, and then when it does run and you get that 15% or whatever that year, you are only getting that return on a reduced amount that you had invested because you had to sell. Remember, it's not just that your stocks were down, it's that you sold at those down prices to pay the debt back, or you took money you could have invested if you happen to have the money when it was down and instead had used it to service the debt. In the end, you may make money, but the upside is only a few percentage points at max, and then you have to account for taxes as well. So in the end, if it works out, you may make 2%, 3%, whatever, with the very real chance of losing money too and not getting any tax benefits like you do in real estate for taking on debt and all the risk in the first place. The risk reward to me is just stupidly bad, and the math is not as simple like you think it is because you're not doing the actual math, including servicing the debt and the taxes. So what gives, Luke? You said you had an answer, but I haven't heard any answers yet. Well, that's true, my friend, but I needed to speak to and dispel all the ridiculous ideas that I see floating around on YouTube. Those will leave you in absolute financial ruin. Unfortunately, the answer to this question is going to leave my comments section in the ruin as well, because some of you are not going to like the answer because you will be challenged to your very core if you take it seriously, or you will just dismiss it altogether because you don't want to do it because you don't want to look at yourself that way. But here we go, guys. There it comes. You need to learn how to master your money. You also need to start a side hustle or pick up some overtime or do both. And you need to take a hard look at your budget and make some tough decisions that won't make you popular with friends and family. Trust me, they are going to be angry, they're going to make fun of you, or probably both of those things are going to happen. You need to reassess your housing situation ASAP. And you need to make lifestyle changes like not watching sports or Netflix so you can work on your side hustle, for example. You need to take a serious look at everything from what you eat to what you drive to everything else in your life. That is the proper way to actually solve the problem of not having enough money to invest in this market. And that is exactly why I have courses on each of those. But you don't need to take those either, I promise, guys. You can get it all right here on YouTube. You don't have to watch Netflix. Instead of watching Netflix, you just basically punch it right there in the search bar for YouTube and look all that sort of stuff. There are hundreds of great books on all these topics. You can Google it. Do whatever, just get the information and apply it. We have members that have done it all, and I have witnessed their journey as they executed on it, and their money situation has basically done a complete 180. And some were young in their 20s, and some were older in their 60s, and everywhere in between, kind of in terms of the age, but all of them flipped their lives upside down and are now benefiting greatly from doing it. Age doesn't matter. Having kids doesn't matter. It's simply another excuse that people like to throw out there. And none of the people I just mentioned had prior real estate experience either. And none of them had a big cash pile either, so you cannot use those as excuses as to why you're not doing this. Paying bills is also no longer really a worry for those folks, and having money loops going and expanding to buy the dip is no longer a fantasy, but a reality for all those people. They simply made the decision to actually commit to and then actually do all the things I just listed, and now they have more than enough extra cash to buy this dip hard and we'll have cash flow to put back money to buy real estate when those opportunities come here in the next year or so. And all of them don't have to consider taking on debt to buy all the deals out there that we are seeing right now. That is how you solve the actual money problem instead of debt. Again, you don't need me, you don't need anybody else. The information is all out there. You just have to dive in and do it and actually apply it and put in the work. I could take the easy road. I have access to as much debt as I could ever want, but I will not be using it to buy stocks at all. Using debt to solve the cash shortage problem is just not the right solution. So please do not fall into that trap or listen to all the noise that's out there telling you to use debt in order to get yourself out of this current situation and buy this debt and buy this downturn and get rich on the back end. That's just honestly not the right way to do it. So hopefully this was helpful. And if you don't know how to get a price target or how to do a valuation and want a step-by-step process for doing that, building wealth, and you want direct access to me and much more, remember to check out the pinned comment down below to become a member and at least look at everything you get. And click this video here for the stocks I'm still buying in this market, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.